This video is focused on single entry, or you can also call it incomplete records part 2. I've already created a video on single entry part 1. You can watch it here and that will give you a good understanding of what is single entry. Here we are talking about single entry or incomplete records part 2, which is also called mixed single entry. Now what is single entry? Just to give you a quick recap, there are businesses which followed proper double entry, which means when you buy land and pay cash, you debit land debit and cash credit. But there are certain businesses who either don't have qualified accountant or miss certain transaction, so they are unable to record both sides of the transaction, means the debit and credit. So if that is the case, we take help of single entry, because whether you record everything or you don't, in the end a business has to prepare profit and loss account and calculate profit and losses, right? Hi guys, I'm the commerce specialist. Welcome to my channel where you find videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. Let's begin with the topic. I have a comprehensive question here. I'm just reading it aloud for you, just in case you don't understand my ugly handwriting. It says, below are the details of Stafford's bank account. Opening balance is 9,000. Account receivable means you have collected from your customers 80,000. What you have paid through bank is accounts payable, or you can call it payment to suppliers, 40,000. You have paid wages of 3,000, rent of 5,000. Various expense means sundry expenses 15, and the closing bank balance is 26,000. Mr. Stafford deposited all his takings into the bank account. Please understand, takings means sales. Okay, money received from sales is also called takings. So Mr. Stafford deposited all his takings into the bank account except 10,000, out of which he paid insurance of 3,500 and purchased a PlayStation for himself worth $3,000. Opening and closing balances are given to us. We are supposed to prepare a statement of profit and loss and a statement of affairs, which is also called statement of financial position. But in single entry, generally we refer it to as statement of affairs. Now, because there are some missing figures here, the very first thing we need to start off, before we go on preparing statement of profit and loss on statement of affairs, we need to make some workings, some calculation. So if we are calculating sales, we need to find total sales, which means cash sales and credit sales. So let's have a look. My working number 1 is for total sales. When I say total sales, I am talking about cash sales and I'm also talking about credit sales. When I add these two, I will get total sales. So for credit sales, please remember we need to prepare a T account for accounts receivable. Now when we're preparing T account for account receivable, look at the opening balance. Receivables are assets, so opening balance, brought down balance will always be on the debit side, which is 9,000. And closing balance of all assets are on the credit side. I'm writing here carried down 4,000. You have also collected cash here because this is a bank account. When you receive, you debited bank and you have to credit receivables. So I'm writing here collections. Collection means you have received customer, or you can write here bank as well. How much? 80,000. Now you add these two. This is 84 and minus 9,000. You will get 75,000. Now this is your credit sales. So now I'm going to explain you, if opening balance is 9,000, account receivable opening balance 9,000 means you have to receive at the beginning of the year 9,000. Your customers are not crazy that they are paying you 80,000. If they owe you 9,000 at the beginning of the year, why would they pay you 80,000? Because during the year you must have sold additionally on credit to them. So now it makes sense. If the opening balance is 9,000, you made credit sales during the year 75. So total how much? So total how much you have to receive from customers? 84. Out of 84, they paid you 8,000 and the closing balance of receivable is 4,000. So when I have credit sales, I'm taking that here, 75,000. And here it says Mr. Stafford deposited all his sales into the bank except 10,000. So this sales which was not deposited into the bank is available in the form of cash, which is 10. So when I add this, I'm getting 85,000. So this is my total sales. My next working is going to be for total purchases. Working 2, I'm writing here total purchases. Here again, if there is any cash purchase, I would like to add that. And if there is any credit purchase, I would like to incorporate that also in my calculation. Only then I will get total purchases. So for total purchases, or especially credit purchase, I need to make a T account for accounts payable. Accounts payable is a liability or supplier's account. So check accounts payable, opening balance is here. Because it's a liability, all liabilities have opening balances on the credit side. So I have 4,000 here. Okay, closing balance of accounts payable is 9,500. So it will be on the debit side, carried down 9,500. And now if you check the bank account, you've made some payments to suppliers. How much did you pay? 40,000. So bank account is credited, accounts payable will be debited here. So you can write here bank, you've paid how much? 40,000. Now again, it does not make sense. If the opening balance, you had to pay suppliers 4,000 at the beginning of the year, why would you pay them 40,000? This means during the year, you have purchased goods additionally on credit. So how much were those goods for? So what you do is you add these two. This will give you 49,500 and you minus 4. So 49 minus 4 will give you credit purchases of 45,500. So this is 49,500. Now this absolutely makes sense. Opening balance for your suppliers were 4,000. You owed your supplier 4,000. Then you purchased further on credit. You never paid them. What is the total amount you owe them? 49,500. Out of this, you paid 40,000 and the closing balance of liability is 9,500. Now I'm all set to prepare the profit and loss account. So I'm starting off here. Profit and loss account. So obviously I'll start with total sales or just sales. That means total sales. I'm giving here working 1. My total sales are 85,000. So I'm starting off with 85,000 here. Obviously, less cost of goods sold. You have opening stock. Opening stock is 3,200. Add total purchases or just purchases, that means total purchases. Now here, if you look at cash purchases is not given anywhere here. I'm taking it at 0. Credit purchases, I got 45,500. So my total purchases is 45,500. So opening stock, add purchases is 45,500. When you add this, you will get 48,700. From this, you minus closing stock given in the question, 7,000. You minus 7,000. You will get cost of goods sold, 41,700. You minus this from here, you will get gross profit, which comes to, after gross profit, you have to subtract expenses. Now my humble suggestion is when you reach the expenses part, you got to be very careful. The very first thing you need to check your expenses is from the bank's payment side. You got wages here, wages 3,000. So I'm starting off with wages here. How much is given here? You've paid through bank 3,000. Now if you notice, there is some additional data for wages payable. There is opening and closing balance. Here you have to apply two concepts. One is for accruals and prepayments and the other is matching principle. I have created a video on accruals and prepayments. and I have created a video on GAAP, which is generally accepted accounting principles. So in GAAP video, you will see the details of matching principle, and in accruals and prepayments, you'll get to know where to record opening balance of assets and liabilities, so on and so forth. So I'm not wasting time here. I'm giving you the quick fix here. What to do is, if you have opening liability and closing liability balance, so opening balance of liability will always be subtracted here, which is 1000, because this relates to liability of the previous year. Closing balance of liability is always added. So 3000 I took from the payment of bank. Then we have wages payable, opening and closing balance. So in wages account, opening balance of wages payable is subtracted. Closing balance, because it is still due for the current year, we add. So say 3000 minus 1 is 2000 plus 600. So this will be 2600 is the wages expense applicable to this year. Next expense is my rent in the bank payment side. Always pick the expenses from here. So rent. How much we have paid is 5000. But it's not necessary that if we have paid 5000 is the expense for the year. Maybe we are paying this year, but probably it is for the previous year, which we have not paid. So some adjustment is there. So for rent, we have rent prepaid, opening balance and closing balance. So if we have opening balance of prepaid, that is always added. And closing balance of prepaid means this belongs to next year. That's why I'm subtracting it. So 5500 minus 400, you get 5100 as rent applicable to the current year. I'm repeating. You took wages, how much you have paid? Then there was wages payable, opening and closing balance. Opening balance of payable is always subtracted and closing balance of payable is always added. And opposite is in case of prepaid. We have opening prepaid of rent and closing prepaid of rent. First you take rent from here 5000 and do the adjustment for prepaid. Opening prepaid is always added, closing prepaid is always subtracted. Please make a note of it. Next is sundry expenses. So I'm writing here sundry expenses. And 26,000, there is no adjustment for sundry expenses. I'm writing it 26,000 here. After sundry expenses, I'm coming down here. If you look at machinery, beginning balance was 5,000, closing balance at valuation is 8. So the difference is depreciation. I'm writing here depreciation on machinery. 5000 minus 800 is 4200. And if you notice here, it says Mr. Stafford deposited all his takings into the bank except 10,000, out of which he paid insurance. So insurance is an expense. So I'm writing here insurance worth 3,500. And he purchased a PlayStation, that is for personal use, that is not a business expense. Here in expense, we are only interested with business expenses. Sorry, sundry expenses is 15,000. By mistake, I took this. So sundry expenses is 15,000 actually. So if I add all this, I get 30,400. And when I minus, my gross profit is 43. Expenses are 30,000 something. That means my gross profit is more, expenses are less. So I end up making a net profit of 12,900. Next step is to prepare statement of affairs, which is balance sheet. So obviously, when I'm preparing statement of affairs, which is the balance sheet or statement of financial position, I have assets here. I have equities, means liabilities plus capital. Okay, so when I'm talking about assets, I want assets at the end of the year. Normally we start off with non-current asset. This is an asset. I have building here, which is 800, closing balance. Now I'm moving to current assets. So if I move to current assets, these are from here I will get some of my assets. But remember, we also have bank's closing balance, which is 26,000. So after this, I can take my current assets. One is the bank balance. Bank balance is 26,000. Coming here, stock is my closing stock asset 7,000. So I'm writing closing stock, which is 7,000. Okay. Receivable is my closing asset. Yes, 4,000. Account receivable is 4,000. Rent prepaid is also my asset, 400. So you can call it rent prepaid, which is 400. Machinery is taken. Rent prepaid is taken. Receivable is taken. This is taken. And bank balance is also taken here. So one thing you need to remember is he deposited all his sales into the bank except 10,000. Out of 10,000, he paid insurance 3,500 and 3,000 he purchased a PlayStation 4. So this is 6,500. So he had cash 10,000. Out of that 6,500 is paid. So how much is the cash closing balance? So I'm just writing here 10,000 minus 3,503. This is 6,500. Okay. So you're left with 3,500, which is the cash balance. I will get total assets, which comes to 41,700. On the equity side, you have to write capital at start, or capital at start, another name is opening capital. So for opening capital, please remember we have to add all the opening assets and minus all the opening liabilities. So I am highlighting all the opening assets with red. So look, we have opening bank balance. We have opening stock, which is an asset. We have opening receivable, which is an asset. We have opening rent prepaid, which is an asset. We have opening building, which is an asset. So if I add all this, 9,000 plus 3,200 plus 9,000 plus 500 plus 5,000, I'll get total assets at start. I don't have space here, so if you don't mind, I'm working here. So total assets at the beginning or assets at the start, 26,700. Then less total liabilities at the beginning. Remember, liabilities at the beginning. So opening liability, if you notice here, I have accounts payable 4,000. I have wages payable. Accounts payable and wages payable is the only opening liability, which is 4,000 and 1,000. There is no opening liability I see here. So 4 and 1 is 5,000. So when I minus, I will get my capital at start, which comes to 21,700, which I need here, 21,700. Now in this capital at start, you got to add net profit, which is here. Add net profit, which we calculated 12,900. You add these two, you'll get 34,600 less drawings. So what are drawings? Drawings are money or equivalent taken out from the owner from the business for private use. So if you look at, this was your cash sales, Mr. Stafford's business cash sales, which we did not deposit in bank, and out of this business sales he used up 3,000 to buy PlayStation for himself. So PlayStation he bought for himself, which is for personal use. It's not a business expense. That's why drawings are 3,000 here. So when you minus, you will get 31,600, which is basically capital at end. After this, you got to take closing liabilities. If you look at this December 22, these are closing balances. So we have this as a liability, closing liability, which is accounts payable. So I'm taking accounts payable as a closing liability, 9,500. I also have wages payable, which is 600. It's a closing liability. Wages payable 600. Now let's add all this and see if it comes to 41,700. Yes, it comes to 41,700, which is your total equities. Ladies and gentlemen, This was single entry or incomplete records part 2, where there were some missing figures we calculated. If you have any question relating to this, any queries, write a comment below. I will respond to you as usual. If you are not yet subscribed to my channel, please subscribe and show that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.